Hey everybody, Steve again. So me and Shelly the cat here are going to go over a couple of the problems, a couple of the transactions from the problems in assignment 3 for Accounting 110. So here we're looking at chapter 9. We've skipped chapter 8. And I kind of feel like a lot of these problems are straightforward. I'm going to just kind of point out the things that are a little bit different. So first here, we're going to look at PA1. PA1 and PA2 are very similar, so I'm just going to kind of go over PA1 here. And mainly what I'm going to focus on, because the problem talks about talking about selling goods and also the cost of goods sold. And as we can remember from, from our earlier accounting classes, that you've got your sale, you've got, your cash, or you receive your cash, or you receive your account receivable, and then you have a sale as the credit, so you have cash or receivable as your debit, and then you have your sale as your credit, and that records the sale. But you also have to keep in mind your cost of goods sold, and the cost of goods sold, of course, or COGS, is the cost to us, the company, to sell the things that we sell. So if we have for instance, here we have a vineyard. So if the, say, wholesale cost of the wine for us is $5 and we sell it for 10, then we have a sale for $10, but also a cost of goods sold entry for 5. And so those are always cash, and then sales, and cost of goods sold, and merchandise inventory. Those, I think the chapter does a pretty good job on those. The only thing I wanted to talk about though for problems 1 and 2 is if we look here on the sale on the 5th, and that's when someone uses a credit card. So I'm going to go down, I'm going to scroll down here, and in that case, the cost of goods sold, merchandise inventory part, that stays the same. But what we do want to say is here, they've paid with a credit card, so we now have an account receivable, not with that individual, but with the credit card company. Because, like when someone pays with a card, they're, when they pay, like say if I pay with my credit card, my business now is with me and my credit card company, whereas the credit card company is the one that paid the vendor that I bought my dinner or whatever with, right? Okay. So here, and it covers this in the chapter, but for this we would have, so July 5th, I'm going to go back over to the problem on July 5th. Let's scroll back up. We see that we sold 1,400 barrels of wine with a sales price of $31 a barrel to Melody Sharehouse. She paid using this particular credit card. Cost is for this sale is $18 a barrel. So our cost, our sale price is $31 a barrel. So we'll need to calculate that. And our cost of goods sold is $18 a barrel, which we'll also need to calculate. Now, as is the case with most credit cards, the credit card charges a fee for the transaction, right? In a lot of cases, it is a standard amount. Maybe it's, 50 cents a transaction or something. But here in this case, they do a fee based on the total transaction. And it's a 2% fee. And that fee is paid for by the vendor, paid for by us in this case, the vineyard. So we have to calculate that. And we have to account for it when we're doing the sale, because, we're not going to get 100% of this is, the sale as revenue, because we're going to have to deal with that fee. So first thing we want to do here is that we have, what was this? I already forgotten. We have 1,400 barrels. We have our sales price of $31, and we have our cost of goods sold price of $18 per barrel. So I'm going to go over here and open up my calculator. We got 1,400 barrels. That we know. Barrels or bottles? Barrels. I don't know, is that a good price or bad price? I don't drink wine. So anyway, it doesn't matter. So we have $31. So our sale price, is 1,400 times 31. So we're dealing with a sale of 43,400. I'll write that down before I forget. 43,400. And our COGS, of course, is going to be that 1,400 times the $18, which is our cost. So we've got 25,200. Okay. So if we go in here, pause recording just for a second. Okay, so we have our sale price. We're selling this for $43,400. We have our COGS of 25,200. We still need one more number, and that's going to be the amount of the fee that the credit card company is charging. And we look back at the problem, and we see that it is a 2% usage fee based on the total sale per transaction, right? So this transaction, because it's how much the sale price is going to be 43,400, and we're going to multiply that by 0.02 to get 2% of that amount, and that's the amount that the fee is going to be. People that, and so we've got $868. So that's what we have to pay to the credit card company for the privilege of them, paying. So I'll go back over here, and again, I'm just going to skip down to 5 because this happened on July 5th here, or July, and we're going to put in. This is the key here: is that for our debit, it's an account receivable. I'll just put it right here. From those that say it's money plus credit card. Okay, so we have that. And so this account receivable is going to be not the entire amount, because if we go back to those rules of accounting. Accounts receivable, it's an asset. Assets are debit normal. So it's going to be on the debit side, of course, since accounts receivable is going up. But also that fee is going to be an expense, because it's it's the fee, it's an expense for the company. And so that is also going to be a debit. And so for this transaction, we're going to put our credit card fee. Credit card fee expense, credit card expense, anything that's going to, whatever makes sense to the business. And so that one is going to be a debit as well. And then for our credit, and if we go back to that, basic of cash sales or receivable sales, the same thing applies here, and we put in our sales. Now our sales revenue is going to be the same, because the sale that we made was for 43,400, but the amount that we're going to collect from the credit card company is going to be that 43,400 minus the fee that they're going to charge, minus that 2% fee. And that's how much money that we're going to receive from them. So their account receivable is 43,400, excuse me, subtract 868 from that. And I actually have that written down here. So that is 42,532. That's what our receivable is. And then we calculate that fee of was it 868? 868. And there we go. And so that's what we do. And then we would go down, and our COGS, I'm just going to put COGS, you put cost of goods sold, would be 25,200. And merchandise inventory would also be 25,200. And then when the credit card pays, and that's going to come up later, they only have to pay this amount because part of the sale that has been made, got taken out in fees. So that kind of covers what I would say the different or the novel part of problems 1 and 2. As I look through the rest of the problem on problem 1, kind of the only other things that might get you, remember that sales discount on July 13, you're going to have to calculate that too. And if we look on the second one, same thing. It's a very similar problem. You just make sure you're doing your credit card fees, just like I showed here, and also make sure that you're applying any sales discounts if they get, if they pay, before the terms, pay the 10 days or whatever, 2% off. So just make sure that both of those are there, and you should be good to go. As always, ask me any questions if you have. I'm going to pause the video real quick, and then I'm going to get set up for the next problem. Okay, so now we're going to look at problem PA4. This chapter looks at credit card sale, and it looks at bad debt, and then I think the end of the chapter has some stuff about notes receivable as well. We're going to focus here on these last two problems with bad debt. And, again, these videos assume you've read the chapter, but bad debt is, the purchases that have been made on an account for a company that, for whatever reason, are just not going to get paid. It happens, when it happens. Some of us may have done that in the past, But anyways, what a bad debt, the allowance for doubtful accounts, versus the direct write-off method. And, you know, books will always kind of mention the direct write-off method in passing because most places don't use it because it's not GAAP compliant. But so we're talking about the allowance method here, and there are two ways to the allowance method. Both of these are, keep in mind that both of these are, that's what I'm looking for. Predictions. That's not the word, but they're both these are, you know, they're both based on a best guess. And so in this case, and that basic the estimation, that's what it is. They're both based on an estimation, and the estimation is based either on kind of, you know, the history of the company. You know, in general, people don't, you know, pay this much of the accounts, or maybe like if it's a new business, this kind of like an industry standard, something they would know. So these are all estimates, right? And they get adjusted along the way. And the two types that you have are the income statement method, which uses a % of sales, and the balance sheet method, which uses a percentage of your total accounts receivable, not the accounts receivable for specific people, but the total accounts receivable account. So in order to get the numbers for these, you really just, you based on that estimation, you have a number that in most cases a textbook will give you, but you know, if you're in business, you know this number. And then you calculate that based on whatever type you're using to get that number, right? So if we're using, let's see what we have here. For this problem, we have, scroll down. Okay, right here. We have 861,430 in credit sales. So this is what we're going to use. We're going to use the income statement method. And we have 488 in total accounts receivable if we're going to use the balance sheet or the % of accounts receivable method. So the first two here, we're just doing an entry based on those two methods. And I'm kind of going to let you do those on your own, but I just want to make sure that, you know, when you go through here, excuse me, that, you know, for here, and the book has the entry, and I mean, I can tell you the entry, the bad debt allowance for doubtful accounts entry is the same every time. The bad debt expense allowance for doubtful accounts, right? So those are going to be your entries. What we're worried about is those numbers. And so I'm not going to calculate those out because it's kind of the point of the assignment, right? But for the first one, you're going to be basically looking at 2.3% of the total credit sales. And so, you know, you'll take you to this and you'll do, you know, 861,430, figure out how much 2.3% of that is, and then 488,000, figure out how much 3.6% of that is. Those are the numbers you'll use. Then as you go, it's going to be based on what type of allowance method you're looking at. And here's a big hint for the problem, is that when you use the income statement method, when you're just using % of sales, that doesn't get brought over year to year. You're only worried about the year in question. I don't really want to give too much more away than that because it kind of gives away the problem if I don't, but just for the rest of the problem, just keep in mind you're only worried about this year. Whereas if you're using the balance sheet method or the % of receivables, that previous balance matters. And that's about as, well, again, there's not a ton to this, so I just don't want to give too much away and let you work it on your own. Again, of course, if you have any questions, of course, get a hold of me on Canvas. And then finally, we're going to look at the last problem too, and it works a lot in the same way as problem 4, but with problem 5, keep in mind we're only using, because what we're doing now is it's a aging method. We're using the aging method. What is this called? Yes, it's an aging of receivables method. Aging method. Learn your words. But anyway, and basically what this means is, and it makes a lot of sense if you think about it, is that, like, let's say that you have some customers and they have some overdue bills. And you know that if it's within the first 30 days, you know, people forget, you know, they misplace the bill, they, you know, wait till payday, right? So they might be late for a number of reasons, but in most cases, they're still probably going to pay. Now you get past 30 days, you get to 90 days, you know, if we're looking at the problem here, you know, maybe there's a lot less chance they're going to pay. And if you go over 90 days, Again, for this business in particular, you're looking at it, they're saying about half the time people aren't going to pay. So the first thing that you want to do in this problem is calculate, and what it's saying is we have 1,166 grand and some change that are between 0 and 30 days due. How much of that is, how much is 15% of that? Put that there. Second one down, we got about 600 grand, whatever that, 577,000. How much is 33%? 33% of that, put that in there. 48% of this number, calculate that out. That gets you your total bad debt expense and uncollected debt amount. And then for the rest of the problem, well, not for the entirety, but for parts C and D, we're going to be using the previous balances. They matter because the aging method is only used in the balance sheet method. I talked before about how the previous balance matters in the balance sheet method, where it doesn't so much in the income statement method. Keep that in mind for this problem. And then the last one is just if someone does, we do have a specific account that is identified as uncollectible and doing the entry for that. That's in the book and pretty clear. And so that's just kind of a starter, kind of an overview of the homework. Again, the learning objective is there with the problem, so if you want to go back and read about it, kind of wrapping your head around some of the bad debt stuff can be a little bit difficult sometimes. And again, as always, hit me on the Canvas or come by the virtual lab if you have questions. Okay, that's a little primer, a little starter then for the homework for assignment 3. Good luck. Right, Shelley? Shelley does not care. Bye-bye.